Entrepreneurs, if you are serious about building your business, then you need to be taking the money that you're making from your business and investing it back into your business, as opposed to taking that money and investing it in stocks and real estate, because none of those things are going to help build your business. But then the question is, when do you diversify? And when do you start taking some of this money and enjoying it for yourself? And the reality is, you're going to have to find where along the spectrum is right for you. Sam Walton, in his book, Made in America, the founder of Walmart, talks about this, which is very interesting. He says that when he was building Walmart, he wasn't investing his money into stocks. He wasn't investing his money in other places. He invested his money into one place. And the one place where he invested his money was Walmart. He didn't want to diversify. He put all of his eggs in one basket, which is his own company, which allowed him to grow his company. Now, did he take a risk? Absolutely. If Walmart went bankrupt, he would have lost everything. But that was what was important for him. Now, do you have to be as extreme as him? No, you don't have to build a multi-billion-dollar company, but you got to figure out where along the spectrum do you want to be. And this is where you have to figure out now, as you start to make money, when do you put it back into the business? When do you pull some money out? And when do you invest this money in other places like stocks and real estate? Because when you're building your business, there's no limit to the types of returns that you can see, right? When you put your money into the stock market, or when you put your money into the real estate market, you're generally trying to get a 7 to 10% return on your money. That is the average return on stocks and real estate over the last century. So when you take your money out of your business and now you put it into stocks or real estate, now you're getting a little bit of a return, hopefully. But when you take that money and you put it back into the business, now you're not trying to get a 7 to 10% return on your money. I mean, even late stage startups are still trying to grow by 20% or more. But if you're an early stage company that has a lot of room to grow, now you could be growing by 50%, 100%, 200%, maybe even 2,000% a year in the early stages, because you take the money and you're investing it smartly back into your company. Now, there's also a risk here, because when you take the money and put it back into your company, sometimes you're going to lose. When I was investing money into my blog, because I wanted to build the Minority Mindset blog, I wanted to turn it into this self-funneling revenue stream where, okay, yeah, we can capture the Google searches, and people search these financial terms on Google, that my blog will show up, and then you're going to get all these amazing articles, and that's going to generate me money. Well, guess what? I probably put like $500,000 into that blog over the course of 18 months or so of hiring the smart people, hiring consultants and doing it. I wasn't putting my time into it, but I hired people to help take care of it, and it was a complete flop. Sometimes you're going to lose money. All the $500,000 went down the drain, and I'm never going to see that money again. Now, yeah, that sucked, and that's a risk you take. But if you keep investing back into your company and you stay consistent with it, sometimes you're also going to make smart investments which will grow into something way bigger. And that's where now you have to find what's most important for you right now. Now, if you're looking for general rules of thumb, look, if your business is not making $500,000 a year, you should not be investing your money into stocks. You should not be investing your money into real estate. Right now, your money needs to be going back into the business to learn how to grow the business, to learn how to scale the business, to learn how to sell more products, to learn how to market, to learn how to get more customers. Because right now, in that stage, you have to get more money. Once you get to $1 million and more, now you have the potential to kind of figure out where and which direction do you want to go. Because now you can have the cash flow to prove your concept. Once you're making $1 million a year, you can kind of prove that, okay, I have found something of value. And that's where then you can decide, do you want to continue building this business into something a whole lot bigger, or do you want to start taking your foot a little bit off of the gas pedal, take some of this money out for yourself, and take some of this money out to invest it into other assets that we have some diversification. And now you can also start deciding, well, how much salary are you paying yourself? And now out of the salary, how much are you going to be investing as well? Like what I do here, I'll give you just my personal example. I'm not telling you what to do. I don't recommend what I do to anybody. I'm just going to tell you what I do. When I make money in my company, meaning when I generate money from my YouTube channel or from whatever I do, my speaking gigs, I don't take that money and just put it in my personal bank account. If I go out and I charge $20,000 for a speaking gig, that $20,000 goes into the business bank account, and then I pay myself a salary out of that. I pay myself 20%. That is my commission. I pay myself, I'm on commission in my own company. I pay myself 20% of the revenue that I generate. So if I generate $20,000, that means I will pay myself $4,000. The other $16,000 stays in the business, which then goes back into the business to be reinvested. Now, when I get paid my salary, the majority of my salary is being passively invested. So I get my salary, I get a salary once a month, which is a commission off of the revenue that I get from like my YouTube ads and other things that I do. I take the salary. Now, most of this gets passively invested. Where does it get passively invested? It gets invested into places like the stock market. It gets passively invested into physical gold. Some of it gets passively invested into places like cryptocurrency. And then if I have a real estate opportunity, I will find money to do that as well, wherever that might be, because I also have my savings there as well. But the bulk of my money is being invested back into the business. Now, you might be thinking, but Jaspreet, then how do you go out and fund a big lifestyle? Well, I don't spend a lot of money. Most of the expenses that I have are write-offs. When I go and travel, these are for business purposes, meaning they come out of the business account. When I go out to eat, most of the times they're write-offs because I'm typically meeting with somebody and having a business dinner. Because guess what? A business dinner is a write-off. Me sitting by myself eating at a restaurant is not a write-off. So I want to make sure I have as many meals as possible with business people because that then becomes a tax deduction. I don't have an expensive car. I don't have expensive purchases. I don't have fancy watches. I don't have fancy clothes. So my personal expenses are very low. And yeah, I have business expenses, but that's where now I am really focused right now on building. Right? I'm working to build Briefs Media, which is my newsletter company. That's where my focus, my time, my energy, and my money is going. I do have my passive investments, and I kind of got started in a unique way where I started by investing. I started by working to buy rental properties. That was like the name of the game for me for a decade, where I learned about real estate investing pretty much on accident. And then I did whatever I could to make money to buy rental properties. I wasn't spending money on other things. I wasn't going out and blowing money on vacations. I wasn't going out and buying nice things. I was making money from all of my entrepreneurial ventures, whether it was event planning, whether it was wholesaling real estate, whether it was selling real estate as a licensed real estate salesperson, whether it was running my other businesses. I made money and I bought as many rental properties as possible to build a real estate rental portfolio, which also pays me with cash flow. And that cash flow is things that I will spend because this is passive cash flow, or generally passive cash flow. I still have to manage my portfolio and my managers, but generally passive. And then after doing that was when I really got more into business, learning about scalable businesses. So I kind of got into things a little bit backwards, but that was just what worked for me. So now my focus is building that active business. And this is where you have to figure out as an entrepreneur, what is the most important thing for you? Now, because I got involved with real estate early and because I got involved in investing in the financial education side early, I love the game of putting money to work. I love the game of investing. It's fun for me. So yeah, I still do that. I'm not actively buying stocks and real estate the way that I used to. Back in the day, it was, I made money, I'm going to go out and buy a rental property. I'm going to go out and look for an apartment complex. I'm going to go out and look for stocks to buy. That was where most of my time was going. Now, it's more of if I see a great opportunity, I will go out and take it. But most of my time is being spent taking the money, putting it back into the business and working to grow the business. Is it risky? Absolutely. Briefs Media could go bankrupt. If it goes bankrupt, I will lose all the money that I put into the company. I will lose all the time that I put into it. And it would be a big, loss for me. But that's the risk that I'm willing to take. And now you as an entrepreneur got to find the right balance for you. There's no secret sauce to how you do this. There's no secret percentage of how you do this. Some people, Sam Walton, went 100% into his company. I'm not there. You got to find where is the right percentage for you. Is it 20%, 50%, 70%? What is that right percentage? And at what point then are you okay pulling your foot off of the gas pedal? And that's where you got to figure out now as an entrepreneur, when do you ease off of the gas and when are you comfortable? And if you can build a business big enough, well, you could also hire somebody else to take your spot if you feel like you don't have that same drive and commitment to keep taking it further. And that's where you got to figure out now as an entrepreneur, as a CEO, as a person running the company, where it is that you want to be and how can you scale the business the way that's going to be best for you. No one can perfectly time a recession. But there is one recession indicator which has warned investors of every recession coming for the last 5 decades. And right now, this recession indicator is flashing some big red warning signs, but most people are choosing to ignore it. This indicator is called the inverted yield curve, and today this inverted yield curve is showing some of its biggest warning signs that we have seen in more than 4 decades. So the question you probably have is naturally, are we about to enter a recession? But it's not so simple. And let me start by backing up and explaining what is a yield curve. Let's say I wanted to borrow $100 from you, but I only needed to borrow this money for a week, 7 days. You might say, okay, Jaspreet, I know you're creditworthy. I know you're going to pay me back. You only have to pay me 2% interest because it's such a short-term loan. That means you're lending me money for the short term and you're only going to charge me 2% interest. But what if now I come to you and I say, hey, I need to borrow that same $100, but I'm not going to pay you back in a week. I'm going to need the $100 for the next 7 years. Now you might say, okay, Jaspreet, I trust you. You're still creditworthy. But if I have to let go of this $100 for the next 7 years, that means I can't keep making more loans, so I'm going to have to charge you a higher interest rate because I'm not going to have that money back for so long. So now you might charge me 6% interest for that same loan now over 7 years as opposed to 7 days. So now this longer term loan that you're giving me is at a higher interest rate. And this is exactly what a yield curve tells you. Yes, I'm bringing back the whiteboard here, but what it shows you is right here we have time. The further you go out this way, the longer the term of the loan is. And over here we have the yield or the interest rates. And what you'll see on a standard yield curve is that the longer the loan is, the higher the interest rate is because it's a little bit more risk. I mean, even if you go out and get a mortgage, your mortgage rate on a 30-year fixed rate mortgage is generally going to be higher than a 15-year fixed rate mortgage because the bank has to part with their cash for a longer period of time. And so to compensate for that risk, they charge you with a higher interest rate. That's exactly what this is showing you here, and this is what a yield curve is. This brings me to part number 2, which is what's an inverted yield curve. Let's go back to the previous example. When you have an inverted yield curve situation, that means the shorter term loans are paying out higher interest rates than the longer term loans. So if I wanted to borrow that same $100 from you and I wanted to borrow it for a week, now I might be paying you 6% interest to borrow the $100 for a week versus if I borrowed it from you for a 7-year period, now I might only have to pay you 2% interest to borrow it for a longer period. Now you might be wondering, why in the world would somebody ever do that? And the reason why is because people are worried about issues going on in the economy. And now you as the investor might say, well, I'd rather get 2% interest guaranteed for the next 7 years than have to keep dealing with the ups and downs in the market, so that 2% interest over the next 7 years is safer for you as an investor, which is why you're willing to accept a lower interest rate over the longer period than a shorter period. So when you have an inverted yield curve, it looks like this. You can see it's an inversion of this, which is where now the longer the loan, the lower the interest rates that you're paying or that you're getting paid, depending on which side of the equation that you're on. This brings me to the third part of this whole equation that you need to understand, which are treasury yields. Now, if you do want to stay up to date on what's happening in things like the economy and interest rates and the real estate market and the stock market and the crypto market, I created a free newsletter called Market Briefs where my team is breaking down what's happening in the economy. You can read this newsletter in less than 5 minutes every morning, and it's completely free. So if you want to join Market Briefs, it's a free newsletter. You can go to briefs.co/market. That's briefs.co/market, and I also got the link for you down in the description below. In our previous examples, you were lending money to me, Jaspreet Singh, a random guy on YouTube. But instead of lending money to me, you can also lend money to the United States government because the United States government always needs money. They keep spending money that they don't have. This is called the national deficit, which means the government generates dollars through taxes, and then if they spend more money than what they bring in, which they always do, they need to cover this deficit. The way that they cover this deficit is by borrowing money. Now, one of the places that they can borrow this money from is the Federal Reserve Bank, our central bank here in the United States, or they can also borrow this money from regular people and banks and institutions, so you can lend money to the United States government and get paid back with interest. Now, the United States government is known as a risk-free investment, partially because they have the ability to work with the Federal Reserve Bank to print as much money as they want, so they have the ability to pay back their bills. And so if you lend money to the United States government, you have the ability to get paid back interest. This is what a treasury is. Treasuries are loans that you give to the United States government, and the yield or the interest rate that you get is known as the treasury yield. So now if we go back to the charts that I created, this is what a yield curve looks like, which means if you're going to lend money to the United States government for, say, 2 years, that would be a lower interest rate that you'd receive than if you'd lend money to the government for 10 years. The longer time that you're lending money to the government for, the higher interest rate that you'd expect to receive because you're parting with your cash for a longer period of time. This is how it works in a normal world when you have this traditional yield curve. But what we're seeing right now is an inverted yield curve, and more specifically, when investors like to look at the yield curve, they like to look at two different types of treasury yields. They like to take a look at the 10-year treasury yield and the 2-year treasury yield, because you can lend money to the government for a month or 30 years. But the numbers that investors like to take a look at are the 2-year and the 10-year treasury yield. So I'm not going to try to get into all the other complicated stuff. Let's just focus in on the 2-year and 10-year treasury yield. Traditionally, when you have a normal yield curve, the 2-year treasury yield is going to pay you a lower interest rate than the 10-year because, well, the 10-year is a longer period than the 2-year. But when you have an inverted yield curve, that means that the 2-year treasury yield is paying you a higher interest rate than the 10-year treasury yield, which means you would earn a higher interest rate in a shorter period of time than if you invested your money or lent your money to the government for a longer period of time. Now again, this is where you have to understand a little bit of psychology. Why would you be willing to invest your money into a 10-year treasury yield and get a lower interest rate when you can get a higher interest rate with a 2-year treasury yield? And the reason why is because if you're worried about the state of the economy and you just want a guaranteed yield for the next 10 years, instead of having to deal with the volatility of the markets over the next, let's say, 8 or 9 years, well, then you can invest your money into a 10-year treasury yield, get a lower but stable interest rate versus investing your money for the 2-year yield and having to deal with potential market downturns. Because if investors are worried about the next few years of the economy, they don't want to have to keep investing your money, and they'll just invest their money for the long term and get a guaranteed return, as opposed to doing more of the short-term investments and getting the higher return, but then having to deal with the market volatility and potential economic downturns. And to understand now the accuracy of these treasury yield inversions, let me read you a line from a CNBC article. The article says, in fact, since 1978, the yield curve has inverted 6 times, not counting the current inversion period, and has preceded a recession each time. So essentially what that's saying is every time we've seen the 2-year and treasury yields invert like this, we have seen a recession come after that. But the question is, how long do you have to wait for a recession? Because if a recession comes 8 years after this yield curve inverts, well, that doesn't really give you a very good indication. So let me read you another line from a CNBC article. Going back to 1978, it takes about 15 months on average for the economy to enter a recession after the yield curve inverts. Now, I want to remind you, this 15-month period from the yield curve inverting and a recession starting is the average. Sometimes it's been longer, sometimes it's been shorter, which brings us to the question of, where are we today? Well, we originally saw the yield curve invert back in March of 2022. Now, the interesting thing about the yield curve inverting back in March of 2022 is you would think that people would say, okay, the yield curve is inverting, there's some red flags in our economy and we should start preparing or start understanding what's going on in the economy, right? Well, that's not exactly what happened. Instead, what you heard a lot of people say is essentially, this time is different. You don't have to worry about the yield curve here. There's nothing to worry about. The economy is strong and everything is just fine. It's going to come back to normal in no time. Now, if you've been doing the math, if it takes on average 15 months for a recession to start after the yield curve inverts, that means if the yield curve originally inverted back in March of 2022, that would mean on average a recession would have to start sometime between September or October of 2023. Again, just an average. And you're not going to know that a recession has started until 6 months after the recession starts, because the technical definition of a recession is 2 quarters, aka 6 months of economic slowdown, and you don't know that you're in the economic slowdown until after it's been declared, which is 6 months after the economic slowdown, but it's again an average. So it takes 15 months on average for an economy to enter quote-unquote recession after a yield curve inverts, but it could also take longer. But this brings us to the question, oh, where are we today? Because after we saw that March inversion of the yield curve back in 2022, we didn't see many red flags. Instead, we saw everybody saying it's nothing to worry about, it's going to go back to normal. Well, it did not go back to normal. Instead, what we saw happen was that the yield curve inverted even more. In fact, we saw the strongest yield curve inversion in the last number of decades happened multiple times in 2023. So no, we did not see the yield curve go back to normal. Instead, we actually saw this steepen even more, meaning you'd see a higher spread between shorter-term treasuries and longer-term treasuries. Now again, the question is, what is the sentiment around this yield curve inversion? Are people paying attention to it, or are they saying it's not that big of a deal? Well, you might not be surprised to hear that people have been blowing it off. Investment News put out an article titled, "Don't Fear the Yield Curve." Bloomberg put out a piece titled, "Is the Yield Curve Still a Liable Recession Signal?" And of course, the Federal Reserve Bank put out their own article saying, "Don't fear the yield curve, reprise." Now, if you've studied financial history in any capacity, you know that every time you've seen an economic downturn, leading up to the economic downturn, you had a lot of financial people essentially saying, this time is different. We're not going to see the bubble burst. We're not going to see any downturn in the economy because the economy is so strong, because this time is different. Now, of course, is this time different? Yeah. We have a lot more money floating around in our economy today. We have a lot easier access to debt floating around today. Maybe not the same way as it was before the 2008 crash, but we have a lot more credit card debt. We have a lot more home equity lines of credit being issued. We have a lot more home valuations rising. So it's a different environment, but we still have a lot of money floating around, and we have a lot of debt floating around. And that could contribute to how long it takes to see an economic slowdown. But you can see that investors are naturally worried about the state of the economy based off of how they're investing their money, because you have a lot of investors saying, well, we don't really want to have to deal with this market volatility over the next number of years because we don't know what's going to happen. We think there's going to be some sort of correction in the economy, and because of that, we don't want to have to deal with it. We don't want to put our money into the markets. We don't want to have to deal with the economic downturn. We don't want to have to deal with the volatility. Instead, we're just going to wait it out. We're going to get a slow and steady, consistent return over the longer period and not have to deal with any of that stress. Now, what does this mean for you? Could this yield curve inversion be wrong? Sure, I mean, anything can happen, but you want to understand this because if you look at the current state of our economy, we have interest rates that have gone up very quickly over the last 18 months. The Federal Reserve Bank has raised interest rates by over 5% in 18 months, which is one of the quickest speeds that the Federal Reserve Bank has raised interest rates ever. And this comes after a time where interest rates were at their lowest levels in the history of American modern history. So the Federal Reserve Bank lowered interest rates to the lowest level ever, then they raised interest rates at essentially the fastest speed ever, and now they're trying to cool down demand. They want people to have a difficult time buying a car. They want people to have a difficult time buying a home. They want to increase unemployment. Now, they don't come out and say this directly because that would be politically incorrect. Instead, they say things like, we want to cool demand in the housing market. We want the housing market to return to normal. We want to cool the tightening labor market. What do these things mean? They mean they want less people to be able to afford a home. They want less people to go out and have a job, because if people have less money or less access to money, they'll have less ability to spend in the economy. And if people have less ability to spend in the economy, that cools demand down, and that will help reduce the prices of things growing, because inflation is still around. Inflation is still growing. And because of that, the Federal Reserve Bank is working to increase interest rates to cool down inflation. And the way that they cool down inflation is cooling down spending. And the way that the Federal Reserve Bank cools down spending is by making things more expensive. Now, they can't go to Walmart and say, hey, Walmart, raise the prices of your stuff. Instead, what they do is they raise the prices of debt. They raise the borrowing costs of money, because the Federal Reserve Bank has the ability to control interest rates. Now, the interest rates that the Federal Reserve Bank controls is not the interest rate that you pay on your mortgage. It's not the interest rate that the government pays back, although the Federal Reserve Bank interest rates really do influence the short-term debts. The Federal Reserve Bank influences the interest rates that banks have to pay one another to borrow money in the short term. So it changes the wholesale cost to borrow money. So as the Federal Reserve Bank raises interest rates, borrowing costs across the board, whether it's for treasuries, whether it's for a mortgage, whether it's for a car, whether it's for a business loan, all these interest rates start to go up, which makes it more expensive to have or get more debt. And that then reduces demand, which then cools down spending, which then cools down the economy, which then you can see how that would affect the entire economic system. So what does this mean? Well, we have this inverted yield curve happening right now. It has seen, or has gone to, the most steep inversion that we have seen in many decades, which means this is something you want to pay attention to. You have a lot of people saying, oh, don't worry about it. This doesn't matter anymore. But This is where it is your job not to just blindly trust anybody, including the Federal Reserve Bank, even though they're saying on their website to just ignore this yield curve inversion. What this means for you is it is your job to be financially educated, and it's your job to understand what's happening. That way you can, number one, understand, but also capitalize on potential opportunities that come your way. Because if we do see an economic slowdown, well, that means you could also find some great investment opportunities, because recessions create more millionaires than any other time. However, it requires you to be patient. Because, well, if on average it takes 15 months after a yield curve inverts to see a recession, that means it could take longer. And today we have a lot of money in the economy. And it's not just people having cash in their bank account. It's people having the ability to spend. People have the ability to spend more money on their credit card. Why? Because as incomes have gone up post-pandemic, credit card levels have gone up in the sense that people can now have more credit lines. Plus, home levels have gone up, which means people have more equity in their homes, which means people can pull more cash out of their homes. These are both very, very, very bad things to do as a consumer. I do not recommend you do either of these things, but it means people still have the ability to spend. And as long as people have the ability to spend, the economy can keep on chugging. And this is where you have investors saying, well, we see the red flags in the economy and we don't want to deal with this. And this is where it's your job not to just stay away from the markets, but to understand the markets. That way you can capitalize on opportunities that might come your way. Who knows when we were going to see the actual economic pain? Who knows what's going to happen in the future? But it doesn't cost you anything to be prepared, because yes, there are red flags out there. So what can you do? Well, what I say is 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. This is the time now to, number one, be building your financial education, and number two, be working to prepare yourself, meaning put some cash aside to protect you, because in case something happened to your income, well, you have some cash to fall back on, and in case we do see an economic downturn, you have cash now to capitalize on investment opportunities that might come your way. So just understand what's happening and not panic, but understand what's happening. That way you can be prepared for anything. Let's talk about investing for cash flow, because unfortunately there's a lot of, let's call it poo-poo information out there on the internet when it comes to the topic of cash flow investing, because a lot of people say, oh, if you want to get rich, just get this passive income, create this drop shipping site, start this Amazon store, create this ebook, and you're going to be making passive income, this cash flow. But the reality is, number one, that's not passive. And number two, it is so difficult to generate this type of cash flow. The way that real cash flow investing works for investors and help people become extremely wealthy with cash flow is like this. I'm gonna draw you right here. For my male followers, I'm gonna draw you a mustache, and for our female followers, I'm gonna draw you a braid. In my native language Punjabi, we call a mustache a much and a braid a gut. So now you go to work every single day at this job. Maybe this job is your business, and then this job is gonna pay you a salary. Now you're going to take a piece of the income that you did not spend at Gucci and Chipotle, and you're going to take this money and you're going to invest it into this asset. Now this asset could be something like a dividend paying stock. It could be something like real estate. I'll talk about how you can do this in just a minute, but now you're going to take this money, put it into this asset that's going to be generally passive on your end. Not completely passive, but generally passive. And now that you own this asset, it is going to pay you with cash flow. Maybe you get a check every month. Maybe you get a check every 3 months. Maybe you get a check once a year. Just depends what this asset is. And now you can take this money that you're generating, and you can either buy more of these assets that are going to pay you with more cash flow, or you can take this money and use it to go out and buy you a brand new car. That's going to be your choice, but this is how real cash flow investing works. Now, the thing that you need to understand about cash flow investing that nobody wants to talk about on the internet is that you don't get rich by investing for cash flow. You got to be rich first to get a lot of the cash flow that will make you wealthy. The reason why is because you got to take the money that you're earning that you don't spend at Chipotle and Gucci, and then you take this money to buy these assets. So you need the money to generate the cash flow in the first place. And this is why it's so difficult, is because people hear this idea of generating passive income and cash flow, and it sounds very exciting. But the reality is, when you generate this cash flow, you're generating a return on the money that you invest. So let's assume, I'm going to be very generous here. Let's assume that you can get a 10% cash flow return. That's very high, by the way. But let's assume you can get a 10% cash flow return. That means if you invested $1,000 into this asset, you're going to generate $100 after 1 year of cash flow. $100 from $1,000 it's not going to really pay you much. I mean, it's not going to fund really anything in your life. Even if you invested $100,000, then you're only generating $10,000 a year. Now, $10,000 a year is a lot, but it's not even $1,000 a month. It's not life-changing money for you to go out and start driving a Rolls Royce. You need the money to invest to generate the cash flow. This is where people say, but Jaspreet, if I need millions of dollars to generate a lot of cash flow, what's the point of me even doing that? Well, the point isn't for you to go and invest into this cash flow asset today and never do it again. The point is you go to work every single day. You get this paycheck every week, every 2 weeks, every month. Every time you get paid, you're going to take a little bit of this money and buy this asset. Now, when you do this week after week after week, month after month after month, year after year after year, decade after decade, now you're going to be building a solid stream of cash flow, especially if you're taking this cash flow that you're generating and using it to buy more assets, because now you're making money to buy cash flow, and the money that your money makes is buying you more cash flow as well. And now if you do this for long enough, now you're going to be able to build a solid stream. Now, the more money you invest into this asset, the more cash flow you're going to be able to generate. And this is why I call it the decade of sacrifice. Because if you put in a decade of time where you're working to live smaller so you have more money here, and then you take this money and you use it to buy these assets that are paying you with cash flow, well, now after a decade of sacrifice, you are going to be able to reap the rewards of that, which is now you're going to finally have a solid stream of cash flow. So if you want to go through this decade of sacrifice, which is not easy, I mean, it's the reason why the majority of people will never become financially successful or wealthy. The majority of people do not want to make this financial sacrifice of you working to live smaller and earn more money, not so you can drive a BMW, not so you can buy all the fancy Gucci, not so you can have a big home, but so you can have more assets. And if you put in that work to own more assets that are paying you with cash flow, now you got the checks coming in every month, every quarter, every year. And now you have this money coming in without you physically working, because remember, you got to work here to get this check. You don't got to work here to get this check. This asset cash flow is coming in passively. The only thing you got to do here is make sure that your assets are still good, making sure that you still own a good portfolio of stocks, making sure that your real estate is still good. All you got to do here is monitor it. Here, you got to go into the office or go into work and keep getting that paycheck, because if you don't work, you don't get that paycheck. Here, if you don't work, you still get paid. But in order to get paid here, you got to keep contributing money here week after week, month after month, year after year for at least a solid decade. And if you do that, now you're going to have a brand new stream of income that can allow you to drive that nice car without worrying about the price. You have the money coming in here that will allow you to go on those vacations and not have to worry about the price. You got the money coming in here to buy the fancy clothes. And you don't got to worry about paying for it, because it's your assets that are paying for it. It's not what you are working to pay for. This is how wealthy people really become wealthy, because if you can build this type of cash flow, well, now you have true financial freedom, because now you have assets that are paying for your lifestyle instead of just you working to pay for your lifestyle. This is what it means to become wealthy, because now it's your assets that will fund your finances. Now the question is, what are these assets that you should be investing in? By the way, if you do want to stay up to date on what's happening in the top finance and business news, because you want to be an investor, well, then you can join something like Market Briefs. Market Briefs is my free financial newsletter that I created to help investors stay up to date on what's happening in things like the housing market, the stock market, the economy, and everything in between. It's a completely free newsletter. If you want to join Market Briefs, I got the link for you down in the description below, or you can go to briefs.co/market. That's briefs.co/market. So what are these types of assets that you can invest in? That way you can generate this type of cash flow. Now, I'm going to go over mainly two types of assets. I'm going to talk about stocks, and I'm going to talk about real estate, because these are probably the two most accessible ways for the average person to generate this type of cash flow. When you go out and you invest in a company in the stock market, what you're doing is you're literally buying a business. If you go out and you buy one share of the Amazon company, you become one of the owners of the Amazon company. If you go out and you buy one share of the Apple company, you become one of the owners of Apple. If you go out and you buy one share of Chipotle, you become one of the owners of Chipotle. If you go out and you buy one share of Sweetgreen, you become one of the owners of Sweetgreen. You get the idea. Now you're literally buying one of the pieces of ownership in that business instead of just buying a product that this business sells. Most people just think about businesses as their products. You go and buy things on Amazon. You buy the newest iPhone. You buy a Chipotle bowl. You buy a Sweetgreen salad. That's how most people are wired to think. When you go out and you invest in a stock, now you're actually buying the business instead of the product. Well, some companies in the stock market, not all of them, but some companies on the stock market pay what's called a dividend. A dividend is a cash payment that you get as an investor for doing nothing except owning the stock. Now again, not every company pays out a dividend. And the reason why is because for a company to pay out this dividend, they have to have a big profit. So now when a company makes a profit at the end of the year, there's three things that they can do with this cash. Number one is they can save this money in case of an emergency. Number two is they can reinvest this money back into the company. Or number three is they can just give it away to you, one of the shareholders, one of the owners. Now, when it comes to saving the money in a company, you got to think from the perspective of a business owner. If a company makes $100 million of profit and they kept $100 million in their bank account, well, that's dead cash sitting there. Not every company wants a ton of dead cash sitting there because the $100 million isn't generating a return for the company. Companies want to do something with their money, or at least give this money to their owners. And so if a company has a big enough bank account or a big enough savings account, they might not want to save more money, which then brings us to option two, which is reinvest the money back into the company. Now, if it's a smaller startup growth company, you bet they're going to want to invest all of this money, maybe and some more, through debt and other investment money back into the company because they want to grow bigger. They want to expand their market share. They want to be a larger company. And when a company is trying to grow, they're going to be investing everything that they can to open new stores, open new manufacturing plants, open new research and development facilities. That way they can keep expanding and growing their market share. But when a company becomes even bigger, and now you're a much larger conglomerate, and you don't really see that opportunity to keep investing and growing as quickly, now you might not want to reinvest all this money back into the company, which leaves now this cash back in the bank account. And if you don't want to just save it, well, then you can give this money away to the shareholders, people like you who own a piece of the stock. Now, this is called a dividend. And companies that pay a dividend generally pay out this dividend quarterly, meaning every 3 months. So now, if you buy a stock that's paying a dividend, that means you're going to get a cash payment every 3 months for doing nothing except owning the stock. Now, does this come with risk? Of course. If you invest in a company on its way to bankruptcy, well, eventually they might cut that dividend, or they'll have to cut that dividend. Plus, you could also see the value of that stock fall. And this is where you have to understand how to value an investment and know how to research a good stock. And you might be saying, but Jaspreet, I don't want to do all that. I don't want to keep up with the company. I don't want to research the stock. I don't know how to do that. I don't want to research the financials. That's okay. You don't have to. The alternative to investing into an individual company is to invest in something like a fund, maybe a dividend-paying ETF, a dividend-paying index fund, a dividend-paying mutual fund. Now, instead of investing in one company like, let's just say, Apple, now you can invest into a basket of companies that have, say, 500 different companies in here, and Apple is just one of the companies, and there's 499 other dividend-paying companies in here. So now you can go out and find these dividend-paying funds. Again, you have ETFs, mutual funds, index funds. You go out and find one of these dividend-paying funds that invest in companies that are paying a dividend. Now you invest in one thing that's investing in 500 different companies. Now you can lower your risk because if Apple were to go bankrupt, well, now you have 499 companies to balance it out. This way you can lower your risk and keep getting those dividends. That way now you can just keep throwing your money into one of these funds. So this is option one. You can invest into an individual company. I am not telling you what to invest in, just giving you an example. You can invest into an individual company that's paying a dividend, or you can invest into a fund that's paying a dividend. But again, the key is you got to just keep reinvesting that money. Option number two is you invest in real estate. Now you're going to go out and buy a property. Maybe it's a house, maybe it's an apartment complex, maybe it's an office building if that's something you're into, maybe it's a retail building, maybe it's a mixed-use building, maybe it's a storage building. You're going out and you're buying this property, but you're not buying it to live in or use yourself. You're buying it to rent out to somebody else. So now you buy this property, you rent it out to somebody else, maybe they'll live in or use this property, and then in exchange for them living in and using your property, they pay you rent. Now the key here is this rent has to be enough to cover your property taxes, your insurance, your maintenance, your management fees, any vacancy costs, and then if you have any debt, cover that as well, and then put some money in your pocket each and every month. That's the right way to invest in real estate. You have some people, especially when you're in a very hot seller's market like we've been seeing, when you're in a very hot seller's market, you will see investors go out who have a lot of cash, just go out and buy properties and say, you know what?
I'm okay losing money every single month because I think this property is going to be more valuable next year. So I'll be able to flip it for a profit. That's not the game that I play. That's too risky, that's too speculative because I have no idea where housing prices or real estate prices are going to be in a year. I don't like to play that game. What I like to do is I want to make sure I can make a profit in my cash flow every single month and just keep working to accumulate the cash flow. I just want to keep stacking the cash flow because now I know, okay, this property is going to make me $250 a month. If this property is going to make me $250 a month, I got to buy a second one for another $250 a month. After 10, I got $2,500 a month coming in profit. After 100, I got $25,000 coming in profit. And now it's a game of just stacking cash flow and how fast can I stack that cash flow. Now again, you don't have to be a real estate investor. You don't have to invest in stocks, but you have to start putting your money to work if you want to start generating the cash flow. There's some people on the internet that say that the only way to build wealth is to invest in real estate. Well, there's a lot of people that have become extremely wealthy without ever touching real estate. You have some people that say you have to go out and invest in the stock market if you want to be wealthy. Well, there are some investors that only invest in real estate that have never touched the stock market that have become extremely wealthy. What you need to do is find the right balance for you. Personally, I invest in stocks and I invest in real estate. It's just something that I'm interested in. You don't have to go out and blindly follow anybody else. You don't want to be a sheep. The idea is for you to go out and build your financial education, learn how to invest, and find the right strategy that works for you, that works for your family, and that works for your financial goals. Because at the end of the day, if you want to invest your money, you just want to make sure you get the best returns. For me, I like cash flow because cash flow is something that I can predict. And when I got the cash flow coming in, well, now I know I can go out and spend my money, at least the cash flow that I'm generating, and not really have to worry about it because even next month, I'm going to get another cash flow check. That's the way that I like to run my finances. So if you want to invest your money, you got to figure out the right strategy for you. And well, this goes over a couple ways that you can invest your money for cash flow.
If you have $1,000 sitting in the bank and you're trying to figure out the best way to grow this $1,000 into $2,000, the best thing for you to do is not put this money into the stock market. I'll show you. See, if you have $1,000 sitting in your savings account right now, you have a few different options of what you can do. Number one is you take this $1,000, you go to the mall and you buy yourself a new watch. That's spending the money, but now this $1,000 is going to slowly go down to zero. So you're essentially throwing this money in the garbage. Yeah, you got a nice watch, but that watch is not going to appreciate in value. It's going to go down in value. Option number two is you can save this money. Now, if you take this $1,000 and you put it into a high interest savings account that's paying, let's just say 5% in interest, now you're going to generate $50 over the course of a year. Not a ton of money, but better than nothing. It's better than spending that money. But the third option is you can invest this money. And this is where most people think, oh, well, you can put this money into the stock market or you can put it into real estate, although you're not going to be able to buy a rental property with $1,000 in today's market. So if you put this money into the stock market, now you're trying to grow this money by 7 to 10% a year. That has been the historical average when you invest your money into the stock market. So let's assume you can get a 10% return on the $1,000 investment. That means you invested $1,000 into the stock market. After 1 year, you are going to make $100 of profit. The problem with that is you don't actually make the $100 until you sell your stock, which means you have to sell it, you got to pay taxes, and then you only get that $1,100, but you no longer have an asset. But then the second problem with that is the $100 isn't a ton of money. It's not going to change your lifestyle either. So now the question is, well, how else can you put this money to work and get a return that's going to make you real wealth, that's going to allow you to make even more money, that we can have more money to invest? Because there's nothing wrong with investing your money into the stock market or the real estate market. I want you to be investing your money into these types of passive assets, but I also want you to build true wealth with these passive assets. Because the way that it works when you invest your money into the stock market is you got to make the money, and then the money you make is going to work to earn you more money. The more money you earn, the more wealth you will build. Because if you make, now, instead of $1,000, $100,000, now you can take this $100,000 and put it into the stock market. Well, now a 10% return is $10,000. If you make $1 million and you put this money into the stock market, now a 10% return is $100,000. So you can start to see where that same 10% return starts to become a lot more valuable when you have more dollars to invest. This is why a lot of people say, oh, it takes money to make money. No, that's not true. It takes money to grow your money, but it doesn't take money to make money. And so when it comes to growing your money with these passive assets, stocks and real estate, they are there to grow your money. If you can invest $1,000 a week or $1,000 a month, now you can really start to grow that money because now you're making money and now you can grow that money, and that's where true wealth is built. I don't want you to stop doing that. That's great. But if you only got $1,000 to invest, what you need to do is figure out how you can take this $1,000 that you have right now and grow it. That way now you can take $1,000 every week or every month and put this money into the stock market. How can you take the $1,000 that you have and multiply it so now you can take $1,000 every month and keep throwing that into the stock market? What can you do with this $1,000 today to make that happen? That's what you need to be figuring out, how you can invest that money today. Because if you just put that $1,000 into the stock market today and you don't touch it, well, yeah, you can grow it a little bit. But remember, the stock market and the real estate market are there to grow the money that you've already worked to create. And if you want to be able to grow your money faster and grow more money, you need more money to invest. And this is where, going back to what I said just a second ago, it's important to remember it takes money to grow your money, but it doesn't take money to start earning that money. If you got $1,000 right now, the question is, how can you take that $1,000 and invest it in a way that's going to earn you more money? And this could be investing this money into your education, or this could be investing your money into your income. Now, the way you invest into your education is pretty straightforward. Take this $1,000 and now invest it into classes, books, seminars, coaching, something that's going to allow you to earn more money. Now, before you go out and you spend this money, I do want to give you a little bit of caveat, because the last thing that you want to do is just throw this into any sort of class or education or coaching on the internet, and then you find out this wasn't right for you. So start with the free information out there. Go out and watch free YouTube videos, listen to free podcasts, and then start reading some books. You got to kind of progress down this in a more gradual way, because you want to make sure that you're putting this money into something that's going to actually drive you and deliver you some value. So start with the free content, YouTube, podcasts, blogs. See what it is that you want to learn more about. Maybe you want to build a personal brand. Maybe you want to build your own business. Maybe you want to get a certificate in data science. I don't know. You figure out where it is that you want to invest more of your time and your money, and then you take it one step further. Before you go out and you spend that $1,000 on some expensive coaching or some expensive class, go out and buy a couple books. Spend $50 and go buy as many books as you can on that topic and then read it. If you don't read it, well then what makes you think that you're going to now get a better return by buying a class that takes even more work and more action on your part? If you can't read the book, you're not going to be willing to put in the work on the more intense and work ethic stuff. So now, go buy a couple books. Spend $50 buying a couple of books or a few books on whatever that topic is, and then read them. And if after those books you are still interested and you're still excited about this thing, that's where now you can start investing more of this money into your education. Now you can look at classes, coaching, seminars, whatever it is, conferences. Look into ways to keep expanding your knowledge, but also doing something on this topic. If it's building your personal brand, you better keep making content. If it's building your data science certificate, well, then you got to start working to get that certificate and figure out what you can do with that certificate. If it's building your own business, then you got to start thinking of business ideas and you got to start implementing it. And this is where now what you're doing is you're investing in your brain, because if you can invest the $1,000 into learning how you can earn more money, well, now that's where now you're working to earn more money, so you have more money to invest. Remember, the key with earning money is not to buy a faster car. The key with earning money is to own more assets, so your assets can buy you the faster car. You want to make money to own more cash flow, because the cash flow can then fund your lifestyle. And I want you to have whatever nice stuff that you want. I'm not saying don't buy a nice car. I'm not saying don't have a big home. I'm not saying don't have the luxury designer stuff. I'm saying afford it first. And if you really want to be able to afford it and be completely financial free, that means you're using your assets to pay for it for you. You're not working to earn money to buy the nice car. You're working to own assets that pay for the nice car. The alternative thing that you can do is you can invest this money into your own business idea. If you want to work to build your personal brand, then maybe you go out and buy a camera, or you go out and buy some lights. But I do want to caution you with this as well, because most of the time, 99% of the time, you can go out and get started and start building your business, your brand, your product with very little amounts of money. I started my Minority Mindset show, this entire YouTube channel, with less than $500. And I say $500 to be very gracious, but I know it was significantly less than that. I didn't have a fancy camera when I got started. I didn't have fancy lighting when I got started. I had my cell phone, my iPhone that I had, and then I had a tripod that I bought off of Amazon. I think I paid $25 for the tripod, and that was it. I don't have any fancy microphones. I don't have any fancy editing equipment. I don't have anything. I used my $25 tripod. I think I might have bought a $25 light as well. So maybe let's just say $50 or $60 to get started with the equipment. I recorded the videos off of my cell phone with no mic or anything. And then I edited it on the free editing software that my computer had. And then I uploaded it to YouTube. And I kept doing that until I started to get more views and started to get some revenue. And then when I got some revenue, that's when I bought my first camera. And that's when I bought my first lights. And then I went out and bought my first microphone. And that was a tough purchase because microphones are expensive. But it wasn't until I started making money that I started really spending money. And this is a mindset you really have to shift, because most people assume, oh man, I can't go out and do this because everybody's got all this fancy stuff and everyone's spending all this money on advertising and this and that to get started. Well, the reality is you don't need a ton of money to get started. It's not the tool set that you lack, it's the mindset. And this is where your mindset is really going to determine what trajectory that you're going to have in business and your income. Because if you want everything today and you're not willing to put in the hustle and the work to get it, well, it's going to be extremely difficult for you to actually put in the reps to get the success, because building business is hard. Building a business takes time. Building a business takes effort. Building a business takes risk. It took me a long time to build my brand on the Minority Mindset Show. And then I had to figure out, how can I build a business? Because I am an entrepreneur. I didn't really just want to be a creator. I've always had this entrepreneurial mind where I want to be a business owner and I want to run a company, because that's something that I enjoy. Not everybody wants to do that. And so I would try a lot of different things. And I was running businesses before the Minority Mindset Show, and I was investing in real estate before. But for me now, I'm building this content. This is fun. It was a hobby at first, but then I wanted to turn it into a business because I was spending so much time into creating this personal brand. So first I started with building a blog, which failed. And then I had the idea to build the Briefs media brand. Now again, if you wanted to go out and start a media company, generally it would cost a ton of money. And most people have to then go out and either raise debt, or you go out and raise investment capital, venture capital from investors. But I was able to self-fund it because now I could take the revenue that I was making from my YouTube brand, my personal brand, and funnel that here into the Briefs Media brand. And then we were able to grow Briefs Media from a free newsletter to then our whole other platform of things that we're working to build. But all these things were like baby steps that built on top of one another. And even before the YouTube channel, I was doing so many things before I got to YouTube. And so now the question is, how can you now start taking action? And the difficult part here is a lot of people assume that you have to be perfect. You have to find the right thing. You have to find the right idea. You have to find the perfect item to do. But that's not how it works. Perfection can be the enemy of great. And this is where now the key is, you just got to get started. And if you do something that you no longer want to do, you can always pivot. But I guarantee you're going to learn something. I started off in event planning. That was my first business. Then I got into real estate. By real estate, I don't just mean investing in real estate. I was doing that. But I also got my real estate salesperson's license. I also became a real estate wholesaler. Then I got onto the internet. I started selling on Amazon. Then I started my own e-commerce store. And after that, after doing all this and investing in real estate, I then got on the internet with my YouTube channel. And so it's progressions. You got to figure out what kind of path you can take and what is going to be right for you. And what's right for you is going to evolve, but you got to get started and you got to just keep putting in the reps, and you can't keep just trying to be perfect, because if you're constantly just trying to find the right thing to do, you're going to be waiting forever. And this is where you just got to get started. You're going to learn along the way, but you got to start putting in action. So if you got the $1,000, the question is now, how can you take that $1,000 and turn it into something that's going to pay you at least $1,000 a month that you can invest into the stock market or into some other asset class? That way now you can continue to build that wealth but you have to figure out how you can grow that first $1,000 in the first place. By the way, if you want to learn more about Briefs Media, we have a free newsletter called Market Briefs. Market Briefs is my free daily breakdown of what's happening in things like the housing market, the stock market, the economy, the global economy, and the crypto market into a fun, witty, and easy to read email. You can read this newsletter in less than 5 minutes every morning, and it's completely free. So if you have not read Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I'll also link it for you down in the description below. Do you want to know how wealthy people organize their finances? Here's a hint. They don't just keep all their cash in one bank account. I'll show you. What wealthy people do is they have designated money for spending, they have designated money to be invested, and they have designated money to be saved for an emergency. They know what every dollar they earn is going to do. They build a system. I'm working to earn this amount of money, and then out of this amount of money, some of it is going to be spent, some of it is going to be invested, some of it is going to be saved. And the reason why is because they have built a financial plan. They've already built the financial models to know if I invest $1,000 a month or $500 a month or whatever the amount of money is, I'm going to be able to hit my financial goals. But in order to get there, you have to start by at least organizing your money. And the simplest thing you can do to do this is you got to just figure out where your money is going. And this one is a little bit difficult, but it is so necessary for every single person. You have to track your money. In business, we say if you cannot track it, you cannot optimize it. It's the exact same with your personal finances. So what I want you to do is take a piece of paper, take a Google sheet, I don't care, and you want to write down on the top how much money you're making. How much money did you make last month? I don't care if it's from your business, from your investments, your job. Write down where your money came from and write down how much money you made from your income, from your job, from your business, from your investments. Write that down at the top. Then below that, you want to write down your expenses. And you want to spend a little bit of time doing this. This is going to take time. Take out your credit card statements, take out your debit card statements, take out your bank account statements, and see where all of your money went and then categorize them by groceries, by your housing costs, by your vehicle costs. Categorize them and write down every single expense. You need to know where every penny went. And then below that, write the other places where your money went. Did you invest any money? If so, how much and where? Did you save any money? If so, how much and where? Did you give any money to charity? If so, how much and where? Now when you do this, you're going to see a clear picture of how much money you're earning, how much money you're spending, how much money you're saving, how much money you're investing. Now, if you're not saving or investing any money, well, that's already a big red flag right there. And if your expenses are higher than your income, that's another huge red flag. And so now what you're going to see is, where is your money going? And immediately, I don't have to tell you what to do here. You're going to immediately be able to make adjustments in your finances because your money is going to be staring right back at you and saying, whoa, whoa, whoa. You're spending too much money at restaurants. You're spending too much money on airline tickets. You're spending too much money on travel. And if you're not tracking your money, you are never going to have a chance to become wealthy because you can't even see where your money is going. So that's the first step, is you got to track where your money is going. The second thing you want to do now is you have to open up at least 3 different bank accounts. And most banks are going to let you do this for free. If your bank is charging you, go out and find a new bank. You don't want to pay for your banking services. But you want to open 3 different bank accounts. And when you earn money, if you're getting paid a salary from your job or if your business is paying you a salary, this money needs to go into one checkings account. And then out of that checkings account, you want money to automatically be pulled out and put into your other 2 bank accounts. Because your bank account number 1 is your spending money. Bank account number 2 is going to be your investing money. And bank account number 3 needs to be your savings money. Now, the amount of money that you save is going to depend on where you are financially. I generally say somewhere between 3 to 12 months worth of expenses. You got to find the right number for you. I'm not a financial advisor. Everything that I say is for educational purposes only, so make sure you understand that. But generally 3 to 12 months worth of expenses is going to be enough for people regardless of where you are in your life. So if you're 23 years old, you're just out of college, you don't got any financial liabilities, you don't got a lot of responsibilities, maybe you only need a few months worth of expenses saved up. If you're 45, you got kids, you got responsibilities, you got liabilities. Maybe you need 6, 9, or 12 months worth of expenses depending on your risk tolerance. So you got to work to build up the savings depending on where you are financially. Your second bank account, which is your investing money, this is where your wealth is built. And the thing that you want to understand about this is there are ways for you to automatically actually invest your money. And then there are places where you just want to keep this cash waiting for a good investment opportunity. And this is going to depend on you because I personally like both. I have a system where money is automatically invested. Every Wednesday, I have cash that's leaving my checkings account that gets invested into the stock market. I'm investing into different asset classes like even physical gold every month. But let's talk about the stock market. Every Wednesday, cash is pulled out of my checkings account and is automatically invested into the stock market, whether the market's up or down, it does not matter. But I also am putting money into my investment account, my bank account, that's cash waiting to be invested, where I'm looking for a good investment opportunity. Now, this could be stocks, this could be real estate, this could be buying a business, this could be really anything. I'm just looking for a good investment opportunity because I am an investor. I like investing. This is something that I personally like doing, and I want to spend the time in that, and I also understand the risks. And so now you got to understand, what type of investor are you? But the key is you have to separate the spending and the investing and the saving. And the reason why is because when you have all of your money in one bank account, it's very easy to just spend that money, because most of us have this net zero mindset, because we assume if I got $1,000 in my bank, I can spend $1,000. But to prevent that from happening is you want this money automatically put into your investing cash account and your savings account, because now when you don't see that money in your spending account, you're not going to be able to spend it because there's no money there for you to spend. And this is going to make it a lot easier now for you to figure out what can you actually afford. Because when you are working to just spend money and then you invest whatever's left, you are never going to have a chance to become wealthy, because you're prioritizing making everybody else rich. When you're working to spend money, when you're working to buy a nice car, when you're working to buy a big home, when you're working to buy the nice clothes, you're working to make everybody else rich. But when you're working to buy more investments, when you're working to buy more assets, now you are working to make yourself rich. But this requires you now to change the way that you organize your finances, and that's why at the very least, go out and create 3 different bank accounts. Now, a simple rule of thumb that you can follow is 75, 15, 10, which says for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. 10 cents is the minimum that you're saving. And now many banks will allow you to build an automatic withdrawal and deposit into these bank accounts. So if you know that you're going to make $1,000 every 2 weeks, you can take $150 and put it into your investment account, and put $100 into your savings account every 2 weeks. And you can automate this through your bank. That way now you don't accidentally spend your investment money on a brand new TV. That's the first thing. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. The next thing you want to do if you want to really organize your finances is you got to organize your investments. And that means now you got to figure out what is your investing strategy. Like what I was talking about just a couple minutes ago, when it comes to investing your money, you can be more of a passive investor, or you can be more of an active investor, or it could be a hybrid of both. I am a hybrid of both. I invest my money in 5 places. I invest my money into my own business, Briefs Media, along with other companies. I invest my money into physical real estate. I invest my money into the stock market. I invest my money into cryptocurrency. And I invest my money into physical gold. Now, I don't recommend what I do to anybody else, but this is my strategy. Some of these are passive. Some of these are active. Like my real estate investments are active. I have to go out and find rental properties. I have to go out and find good investment deals. And then I go out and I invest in it when I feel like it's a good price in a good area in a growing neighborhood. That's what I'm looking for. When it's the stock market, I have a passive strategy, but I also have an active strategy in the stock market as well. If I see a great investment opportunity in the stock market, maybe it's a great company that has just been hit hard by the economy or by something else going on in the market. Well, now I can go out and buy this company that I believe is a good investment and buy it. But beyond that, I have my passive strategy, which is every Wednesday, I have cash leaving my account and it's automatically being invested. And this is whether the market's up or whether the market's down. It does not matter. I'm always, no matter what, contributing to my investing. Now, the key here is you have to figure out what are you prioritizing. Are you going to prioritize your investing, or are you going to prioritize your spending? Because most Americans, and I'm not saying this generally, I'm saying this statistically, Most Americans prioritize their spending, meaning when something comes up in life, let's just say your friends want to go on a vacation, or somebody's having a baby, or somebody's having a wedding. What are you going to do? Are you going to prioritize paying for that gift or paying for that event? Or are you going to prioritize investing that money first? And if you really want to become wealthy, you have to prioritize building your wealth first, which means sometimes you got to make some sacrifices. And you got to figure out which sacrifices you're willing to make. Maybe you got to downsize your car. Maybe you got to downsize your home. Maybe you got to downsize how many times you're going to eat out a week. Maybe you're going to downsize your clothes. You got to downsize something in order to make the ability to keep investing your money. And as you're doing that, the next thing you want to do is work to earn more money. Now, the reason why you want to work to earn more money isn't so you can drive a faster car. It's so you can own more assets, which will buy you that faster car. That is the key, because what wealthy people are doing is wealthy people are living off of their investments. They're not living off of the money they're working to earn. When you work hard to earn money and then you spend that hard-earned money, you are working hard to make everybody else rich. But when you work to earn money and then you take this hard-earned money and then you buy assets, you are working hard to make yourself rich. Now, these assets are going to be working to earn you more money, because if you own cash flow producing assets like dividend paying stocks or rental properties, now these assets are working hard to pay you. And if you can live off of this cash flow that your assets produce, now you are financially wealthy. Now the tough part is, this is hard. This is difficult. This is going to require you to make some sacrifices, because if you want to live off of your assets, it's going to take a lot of work. And this is why I call it a decade of sacrifice. It's going to take you a lot of time to see any real significant income from your cash flow producing assets. But if you keep putting money into these cash flow producing assets week after week, month after month, year after year, and you do this for a decade, after 10 years, I guarantee you're going to be able to have some significant income from your cash flow producing assets. But it's going to take you a decade. But if you can do that, now you have a whole new stream of income which can fund a big chunk of your lifestyle. But it requires you to start making that sacrifice today. Because what wealthy people are doing is, number one, they have organized their finances so every dollar that they earn has a job. Some of this money is going to be spent. Some of this money is going to be invested. Some of this money is going to be saved. The more money you put towards your investments, the wealthier you will become. Now, as you're investing your money, the second question is, how do you invest this money? Do you want to be more of an active investor or more of a passive investor? Then it's, now, as you're investing your money, how can you use the income from your investments? Because true financial freedom comes from when your assets can pay for your lifestyle, but that's going to require you to put in that work now, to own the assets, to make the sacrifices, build the cash flow, and then start to live off the cash flow. And this is sacrifice after sacrifice, but if you can do this, now you're going to build that true financial wealth, that true financial freedom that most people only dream of. Americans are spending more money than ever before, even if they don't have the money to spend. And this is a sign of how strong our economy is. At least that's according to economists who say that not even a recession can hurt our spending here in America. And what this article says is that there are three main factors which are contributing to the growth and strength in spending here in America. Number one is the money printing that we saw. Number two is the Social Security program, which has been growing thanks to money printing. And number three is people borrowing more money to continue spending. Now, the reason why this is so important to understand and that we're going to dive into this for is because everybody's talking about how strong our economy is because consumers are spending so much money. But at the same time, this consumer spending is a double-edged sword, because if consumers spend too much money, that means eventually they're going to have to pull back on their spending. And when they pull back on their spending, and businesses are reliant on consumers spending more and more and more money, that's when you can start to see a real shakeup in the economy. And what you'll see is that there are real flags with why our consumer spending is so strong right now and why people believe that not even a recession can hurt consumer spending. So let's jump right into this. And let me start by talking about number one, which is how the money printing in 2020 and 2021 is still affecting our economy today. Now, by now, if you've followed anything that's been happening in the financial world over the last few years, in 2020 and 2021, the government and the Federal Reserve Bank worked to print and spend trillions and trillions of dollars and gave this money to businesses, corporations, and people, which gave people more ability to spend, which allowed businesses to create more jobs, which allowed businesses to raise salaries, and which allowed people to pay down their debts, which allowed people to build some investments, and which allowed some people to build their savings. And what this article talks about is the impacts of this money printing today. It says that massive fiscal support during the pandemic and constraints on consumer ability to spend allowed households to accumulate a large stockpile of excess savings, and consumers have been tapping on those funds since the summer of 2021. Now, this is where you're probably thinking, Jaspreet, we're in the middle part of 2023. It's been over 2 years. How does that spending and money printing still affect us today? Well, take a look. Households have likely depleted more than half of their savings buffer, but there's still somewhere between $500 billion to an excess $1 trillion in spending ability out there, meaning people still have more ability to spend because of all the money printing that happened. And you might be saying, but Jaspreet, that was 2 years ago. How does that still affect us today? And I think the difficult part that a lot of people have of understanding is how much money was actually created during the 2020 pandemic. Because when the 2008 crisis happened, when we were talking about a potential $1 trillion stimulus package back in 2008, people were losing their minds, and that was considered impossible to do a $1 trillion stimulus package, so things had to be cut. In 2020, not only was a $1 trillion stimulus package considered not enough, there were multiple multi-trillion-dollar stimulus packages created and spent, in addition to trillions of dollars worth of quantitative easing, in addition to trillions of dollars of infrastructure packages that were created and passed. The amount of money printing that we saw in 2020 was many multiples of what we saw during the 2008 crash, when people thought that we had printed more money than anyone could have ever imagined. And we took the 2008 money printing to a whole new level in 2020. And so apparently, according to economists, and even banks have been talking about this, consumers still have more ability to spend due to still today in 2023 excess supply of capital from the money printing in 2020 and 2021. But it gets even more interesting when you take a look at number 2, which is the Social Security aspect of growth and spending. Now, this is a story that we did cover in Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, I highly recommend you do so, because it's an easy and free way for you to stay up to date on what's happening in the top finance and business news. So if you're an investor and you want to stay up to date on what's happening in the economy, the housing market, the stock market, the global economy, our own economy, into a fun, witty, and easy to read email that we don't get blindsided by what's happening, Market Briefs is a free resource to help you do that. You can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I'll also link it for you down in the description below. Here's what the report had to say about Social Security and consumer spending. And by the way, if you want to read the whole article, I also got it for you down in the description. But what it says is that generous cost of living increases for recipients of Social Security benefits have raised consumer spending. Now, this one is really interesting, because if you've looked at what's been going on with Social Security has been drying up. Number one, because people are living way longer, so Social Security has to keep paying out people's benefits longer and longer and longer. And then number two, because the cost of living is rising, so Social Security benefits have to rise faster than expected. But take a look at what it says next. Social Security beneficiaries received an annual 5.9% increase in benefits in 2022, which was the largest in 40 years. And then they saw an 8.7% increase this year. And this new income, Social Security checks for old people, is of growing importance in the economy, because as the elderly population increases, more people have more spending ability. Now take a look at this. We have a growing elderly population, growing people that rely on Social Security. This is a huge chunk of the consumers in America. And what this article is saying is that because we have more old people in America that are getting bigger checks from the government, they have more spending ability. But the reason why they're getting more checks is because we have more inflation. The reason why we have more inflation is because we saw more money printing. And the way that the government is funding this bigger Social Security checks is by printing more money, which causes more inflation. So if you start to look at this from a true wide lens, what you see is the inflation caused the need for more Social Security checks. The inflation was caused by more money printing. So more money printing in 2020 and 2021 caused the need for bigger Social Security checks. Now the government has to fund bigger Social Security checks through more money printing. And so now, because people have bigger Social Security checks, they can spend more money. And they have to spend more money because the prices of groceries, rent, and everything in between is so much more expensive. And this is a big part of our growing economy, is the spending that old people have through Social Security checks. And because Social Security checks are growing, they're able to spend more money, which is growing the economy. And they're getting the source of this money from the government. And the government doesn't have the money to fund this because the Social Security fund is depleting, and the way that they're funding it is through more money printing. So you start to see the circular argument where you have the inflation problem and you're fueling the economy by producing more inflation, which creates a bigger inflation problem, which starts to create more economic issues. So this is something you want to pay attention to, because a lot of people have been reporting about the retirement crisis that's going on. What is a retirement crisis? That more and more Americans are entering retirement with not enough money. So what are they relying on in order to fund their retirement? Social Security checks. But the Social Security fund has been drying up because now the money you're paying into your Social Security fund, because anytime you get paid from your salary, some of the money is going to FICA taxes. What is that? Social Security taxes. Those Social Security taxes that you're paying today, especially if you're under the age of 45, aren't going to fund your retirement. They're going to fund somebody else's retirement. They're funding somebody's retirement today. And this is where now, in order to fund these growing Social Security check requirements, which are necessary due to the higher inflation, the government has to create more inflation. So this is a definitely indicator of something that you want to be paying attention to, because, well, the inflation problem has not ended yet. And the third factor that's contributing to this booming consumer spending is debt. Take a look. Households have also been boosting their borrowing to maintain spending in the face of high inflation. Many households paid down credit card debt after stimulus checks were sent out, but now we've seen credit card debt jump by 14% in 2022. We here in America live in a credit-based economy, and our economy runs on spending, which means the more money you spend, the more money somebody else gets. If you spend more money, somebody else is getting richer, period. Now, we live in a credit-based society, which means you don't have to just spend how much money you earned. You have the ability to spend based off how much debt you qualify for. So if you go to work and you earn $1,000 and you keep the $1,000 in your pocket, that's not stimulating the economy. That's not making somebody else rich. But if you take the $1,000 and you go and you spend all of it at the Nike store, at the Gucci store, at the Lululemon store, well, now you're making somebody else rich. Because now these businesses are making money and their profits go up. They can hire more employees. They can create more jobs. But because we live in a credit-based society, banks will look at you earning that money and they're going to say, oh yeah, you got $1,000. How about we give you a $2,000 line of credit? So now you have the ability to spend the $1,000 that you earned plus the $2,000 worth of debt, your credit card debt, whatever line of credit that you have. And now you have $3,000 worth of spending ability. So now when you go to Gucci, Louis Vuitton, wherever, and you spend the $3,000, now the people that are getting that money are getting even richer faster because you have more spending ability. And what happened during the pandemic was all this money was printed and sent out, which meant people's debt balances from across the board went lower because some people used their stimulus checks, unemployment checks, free money from the government to pay down their debt. So people's debt levels went down. Well, now what we've been seeing is incomes have gone up, partially due to the inflation. So now people's incomes went up and their debt levels are down here. And now banks are saying, hey, you don't have any debt. You have more income. You're more credit worthy. How about we give you bigger credit lines? How about we give you more home equity lines of credit? How about we give you other options to borrow money? And now what we're seeing happen today is more and more Americans are digging into debt to continue funding their lifestyle or to continue the ability to live. Because now, normally, people would have already had debt and they can't keep going deeper into debt. But because people got this like running rewind on their debt levels in 2020 and 2021, they have the ability to rack up way more debt today because, well, a lot of people just zeroed out their balances and now they have to rebuild it back up. And they have more room to go because if incomes have gone up, your credit worthiness have also gone up. But the problem with this is there's a breaking point. because you can't just keep borrowing money forever. Eventually, you're going to max out your credit card. Eventually, you're not going to be able to pull out more money out of your home. And when that happens, now people are going to have to make a decision. Are you going to work to earn more money to continue funding your lifestyle? Are you going to dig into your savings to keep funding your lifestyle? Or are you going to have to cut back now because the bank is pulling the strings back? And when that starts to happen, that's when you'll see a big shift in spending, because there will be no other option. And this is that concern that a lot of economists are looking at. It's because they're looking at the economy and consumer spending, which is booming today. It's causing profits to go through the roof. It's causing markets to grow. It's causing everything to be good. But that comes with the time span too. It's a ticking time bomb, because debt levels are rising. Inflation is still there. Interest rates are rising. People are spending like crazy. People are digging into the savings to spend. But eventually, people can't keep digging into the savings anymore. Eventually, people won't have the ability to go deeper into credit card debt. I mean, we've been seeing debt levels rise at some of the fastest levels we've ever seen. And part of the reason is because the prices of things have gone up so much. And the other part is because people want to keep spending money. And when that hits its tipping point, that's when you're going to see a real shift in the economy. And so this is where you have to understand, number one, how does our economic system function? We live in a spending economy. The more money somebody spends, the more money somebody else makes. But that spending isn't just spending based off of money. It's a credit-based economy, which means people spend not based off how much money they've earned, but based off of how much credit they qualify for. But when you live in a credit-based economy that relies on spending, there's also a limit to how much spending somebody can do when they tap out their credit limits. Because now when you tap out your credit limits, people have to stop spending, and then they have to start saving, because now they have to start working to pay down their credit card debts. And when that happens, and people start taking their $1,000 that they earn and use it to pay down their debt, and they put this money back in their pocket instead of going to Gucci, instead of going to Lululemon, instead of going to Chipotle, well, that's when businesses start to see the revenues get hurt. And when businesses start to see the revenues get hurt, well, that's when they have to start cutting back. And when they have to start cutting back, that's when you start to see more pain in the economy, when people start losing their jobs. When people start losing their jobs, that's when you start to see that negative spiral. Now, normally what has happened in the past when you see this type of downturn is the Federal Reserve Bank will start cutting interest rates, to start inflating, to start stimulating. But the difficult part today is we're already facing the high inflation problems. That's what makes this economic situation that we're in right now so unique. There's still spending ability out there. Consumers are still spending. We're still seeing that. Why? Well, this article says 3 reasons. Number 1 is because of all the money printing. People still have the ability to spend. Number 2 is because of the Social Security check growth. And number 3 is because the ability for people to go deeper into debt. Well, eventually, when spending slows down, that's when you're going to start to see the shift. And this is where your job as a financially smart person is to understand this, be financially educated, be prepared, meaning be smart with your money today. 2023 is not the year for you to go out and finance a new truck. Be smart with your money today. That way you can protect yourself, but then also put money aside to be able to capitalize on opportunities that might come your way. Because the reality is when you see economic crises, when you see turns around in the economy, when you see market downturns and crashes, that creates opportunity to build wealth, buy more investments on sale. But the only people that can capitalize on it are the people that were, number 1, financially educated to see the opportunity, and number 2, are prepared with cash to seize the opportunity. It's a little ironic, but the things that create a booming economy are the same things that create a broke American. And what we're seeing happen today is more and more Americans are starting to go broke. Our economy runs on spending. When you spend all of your money, the economy booms. When you go into debt to spend more money, the economy booms even more. The more money you spend, the richer somebody else makes. Well, today, we're starting to see a shift in the way people can spend. We recently got some new economic data that says that consumers are strong, but that consumer spending is starting to slow. Let me actually take it one step further and read you directly from what Jamie Dimon, who is the CEO of JP Morgan Chase Bank, had to say. The consumer is in good shape. They are spending down their excess cash. This is why we have booms and busts in our economy. Our economy runs on spending, but then beyond that, We live in a credit-based economy, which means people have the ability to spend not just based off of how much money you earn, but based off of how much credit you qualify for. If you make $50,000 a year from your job and there was no credit, the maximum amount of money that you could spend is $50,000, which means the most you could stimulate the economy is $50,000. If you only spent $10,000 out of your $50,000, that might be good for you because now you saved that 40 grand. You might be investing that 40 grand to build your own wealth, but that's not so good for the economy because that means Chipotle is saying, hey, give us some of your money. Gucci is saying, give us some of your money. Apple's saying, don't you want to buy some more AirPods? But now if you flip things around and you spend $40,000 and save $10,000, now Gucci's saying, hey, thanks for buying our handbag. You want a belt too? Apple's happier because he bought their AirPods. Maybe you want to buy their phone too. Chipotle is saying, hey, you want to buy some more double guac? But then if you take it one step further, where now you make $50,000, but you can qualify for an additional $25,000 worth of debt. Maybe it's a line of credit. Maybe it's a home equity line of credit. Maybe it's a credit card. Well, now you could spend all $75,000 and now you're really stimulating the economy because now you are spending money like crazy. You're walking into the Gucci store, you're buying the handbag, you're buying the belt, you're buying the hat too. You go into Chipotle and you say, you know what? Let me get the double guac and the double meat. Actually, you know what? Give me a side tort too because now Chipotle is charging for their side torts as well. And now you're really stimulating the economy. This is where now you have to understand as a consumer, as an investor, as a person, how this economic system works, because our economic system runs on spending, but also how our economic system is changing, because we're seeing changes happen right now. And these changes can also create more opportunities. So now the natural next question is, why are consumers slowing? Now, obviously, we know the inflation part, but there's two parts that aren't so well understood. Number one is that Americans have less ability to save. And number two is that Americans are tapping into their savings and these savings are being depleted. Let's start by taking a look at how much money Americans save. This data is from the Federal Reserve Bank, and what you'll see is that back in May of 2019, Americans were saving more than 8.5% of their income, which already wasn't enough. But if you fast forward to May of 2023, the average American was saving less than 5% of their income. Why are Americans saving so much less of their income? Well, probably due to the fact that we've had all this high inflation, making rent and your housing costs more expensive, making groceries more expensive, making vacations more expensive. So because of the higher cost of living, people have less ability to save. This brings us to the second factor, which is people now having to dig into their savings to continue funding all of their spending. Let me actually read you this excerpt from CNBC. This article was published in February 2023, and the title is, Amid Persistent Inflation, 54% of Americans are using savings to pay for everyday expenses. And then if you scroll down, it says to make ends meet. 27% of Americans said they've had to take money out of savings, and more than half, or 54% of Americans, said that they've used that money to pay for everyday expenses such as groceries and rent. So on one hand, we have reports saying that consumer spending is strong, consumers are resilient, consumers are keeping the economy booming, but consumer spending is slowing. So the economy is strong because consumers are spending. But the red flag here is that consumer spending is slowing because consumers are ultimately what drive our economy. If people don't spend, the economy doesn't grow. If people are spending, the economy is growing. But ironically, when people spend, then you're going to hit a breaking point where people have to save, because when you overspend, eventually you hit a breaking point. Eventually, you dig all the way through your savings. Eventually, you max out your credit cards. And when that happens, now instead of spending, you have to start saving. Instead of spending, you have to pay down your credit card debt. Instead of spending, you have to start building your savings. Now, these things, the building the savings and paying down your debt, is good for your wealth, but it's not so good for the economy. And this is where now you want to pay attention to this, because why is consumer spending slowing? Well, obviously, inflation is still a problem, but because of this high inflation, number one, Americans are saving less of their money. They have less ability to put money aside. And then number two, more and more Americans are now having to dig into their savings or go into debt to fund everyday expenses. Because now, when you see the higher cost of living, when you go into a restaurant, you see the higher cost of your bills. You go on a vacation, you have the higher cost of the flight. You have to go to the hotel, you have to pay more money for the hotel. Either you're going to say, you know what, we'll just put it on the credit card. I don't want to sacrifice this lifestyle that we've had. I've been liking going to these restaurants every Friday night. I don't want to stop doing that. Or you're going to say, something's going on here. The cost of living is growing very fast. I don't know if we can keep affording living this type of lifestyle. Maybe we should cut back. And for the average person, cutting back is way more difficult than just putting it on your credit card or digging it into your savings. And that's what we're seeing happen right now. Consumer spending is flowing because some people are digging deeper into their savings or they're tapping out on their credit cards. And there's only so much further that you can go. Once that excess cash, the excess savings, the excess debt ability goes away, that's when the consumer spending also goes away. And this is where a lot of people say, but what do you mean excess cash? How do people still have excess cash? How do businesses still have excess cash? This has been a year and a half since the pandemic really stopped. How is there still excess cash? And the thing that's difficult for a lot of people to grasp is the real amount of money that was created to stimulate our economy. There was a statistic that was put out by NASDAQ, which said that we spent more money stimulating our economy in 2020 and 2021 than we spent fueling all of World War II, even after adjusting the war numbers for inflation. So yes, we're seeing big shifts happen in our economy right now. They might not be showing up in the markets or in asset prices, but there are shifts happening in the economy. Some people are noticing, but these are gradual shifts. And that's what makes them so unique, because everybody expects changes in the economy to be drastic and dramatic. But we're starting to see this slow, gradual slowdown in spending. And if spending continues to slow down, eventually that's going to hit businesses' revenues. Because if people have less ability to spend, that means less people are going to go to Chipotle, less people are going to go to Gucci, less people are going to go to Amazon. And if less people are going to be shopping, that means businesses are making less revenues. And that's at a time where costs have risen. Why have they risen? Because of inflation. But in addition to that, we also have huge amounts of debts out there, corporate debts. And these corporate debts are not 30-year fixed rate mortgages. Remember, corporations loaded up on debt in 2020 and 2021. And these are many times adjustable rate debts, where every 3 to 5 years, these debts start to readjust. And what we've been seeing is that in the coming 24 months, we have a lot of corporate debt, a lot of real estate debt that's going to be readjusting. And when it readjusts, this debt is going to change depending on where interest rates are. And interest rates are significantly higher today than where they were 2 years ago, 3 years ago, which means if nothing changes on the interest rate side, that means corporations are already going to be facing higher prices because of inflation, but then number two, they're going to be facing higher costs because of the debts. And if consumer spending continues to slow down because people keep racking up the credit card debt and they dig out of their savings, then there's going to be less ability for people to spend. That means lower revenues, higher costs. And this is where it becomes so crucial and important for you to understand this. That way you can capitalize on opportunities that might come your way. But in order for you to capitalize on these opportunities, that means number one, you have to understand what's happening. Number two, you have to be financially educated. You have to know how to invest. You have to know how to find the opportunities. You have to know how to invest in stocks, how to find good stocks, how to invest in real estate, how to find good investment properties, how to invest in businesses. And then number three is you have to be prepared. Because you can see the greatest investment opportunity in the world, but if you don't have any money to actually capitalize on it, it doesn't do you any good. That means right now, you got to get your money right. 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. And that's why it's so important right now for you to get financially smart and understand what's happening. Because while we're not seeing this drastic shift in the economy today, what we are seeing is this gradual slowdown in spending. And if that continues, that's going to have more and more drastic effects on our economy. The work from home movement that boomed during the pandemic is really starting to come to an end now, as companies are not just asking but demanding their employees come back into the office right now. Now, of course, some companies have seen some backlash from demanding their employees to come back. Like when Amazon demanded their employees to come back, some employees held strikes at their office, some employees walked out of the office, but Amazon really didn't care. They said, okay, if you don't want to come back into the office, just never come back. You can leave. You can leave the company permanently. Same with Google. When Google demanded their employees to come back, there was some backlash over there, but Google said the same thing. We are committed to bringing people back into the office because we need people to be more productive. We found that collaboration is much better in the office, so we need people to come back. Now, naturally, There are some people that are very upset about this. People meaning people who now have to go back into the office. Some people are upset because now I can't take care of my kids like I could before. I can't spend with my time with my family like I could before. I got to spend more time in traffic. And some people are upset because, well, they're working virtually as it is. They do all their work on a computer. They do all their calls on Zoom. They just have to do it in the office. But there is benefit to being in the office, because now when you're in the office, if somebody has a question, they can come directly to your desk instead of having to just Slack you. And this is where now companies are having to make adjustments based off of what's happening in the economy. Because what we're seeing right now is obviously inflation is around. It's making people's spending ability drop, right? Because when the price of your rent and your groceries are so much higher, you have less disposable income to spend on other things. And when people have less disposable income, they have to be more cautious and careful with where they spend their money because they have less money to spend, which means certain businesses are seeing less dollars coming through their doors because less people have the ability to spend. So now businesses have to get very productive because now they are looking at their operating costs. They're looking at the revenues and they're saying our revenues are not growing like they thought. Our operating costs are growing. And now we need to make our operating costs more effective, meaning either we need more work out of each employee, we need better work out of each employee, or we need less employees. And this is where now many businesses across the board, it started off with just tech, and it was kind of funny when we started seeing layoffs in tech. This started in 2022. When the tech layoffs started happening, everybody, not here of course, but most of the traditional media kept saying that this is isolated to tech industries, that no other industry is going to struggle, that it's only tech businesses that are struggling. Today, we're starting to realize it's not just tech. Obviously, tech is one of the hardest hit, but it's not just the tech industry. But now what we're seeing is businesses across the board are saying we have to make these adjustments, and they're asking employees to come back into the office because now each company is needing more productivity out of their employees because what they're finding is the productivity when people work from home is generally less. Is that 100% of the time? No. There are some people that are more productive working from home, but the majority of people statistically are less productive when they work from home. So now companies who are looking at their financials are saying, we have to turn things around. Otherwise, we're going to be out of business in 18 months or 24 months or 36 months or whatever it might be. And so now they're saying we got to get people to be more productive. We need more work out of each employee. And that's where now employees are saying, either, okay, I get that. I'm doing whatever it takes to grow the company. I'm going to come back to work. Or they're saying, I don't want to do that. And it's a real shift in dynamic because now what's happening is the economy is slowing down, which means the job opportunities out there are also starting to shrink. And so companies are saying, okay, if you don't want to come back into the office, just never come back. That's okay. They're looking to reduce their staff size anyway. So if you want to leave voluntarily, it makes the job even easier for the company. So if you don't want to go back into the office, find a different company that will hire you. Companies are embracing that now because they need less operating costs and they need more productivity out of each person because now when you enter a time where the economy is slowing, that means revenues are falling. Companies have to get more productive. They have to get more profit out of the business because when times are good, money is growing, growth is there, you can do whatever you want. The reasonableness as to what an employee can do is really whatever because the company is making money. But when you start to see that shift, well, that's when the companies demand more. And over the last number of years, the power was really held in the hands of the employee. We did a full deep dive on this in Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so because it's an easy and free way for you to stay up to date on what's happening, when it's happening, that way you don't get blindsided by the economy. And if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, or you can click the link down in the description below. But this is where now the shift is happening where 2020, 2021, and even into 2022, the power was in the hands of the employee. Employees were pretty much in full control. Now we're starting to see that dynamic shift. It has not completely shifted yet. We're still seeing a lot of power in the hands of employees today, period. That is 100% true because there's still today way more job openings than there are employees. period. And I'll talk about why in just a second. So employees still have a lot of power, but we're starting to see more and more of that dynamic shift. And if the economy continues to go in this downward direction, if we continue to see high inflation, you're going to see this shift happen even more aggressively, where the power will shift then to the hands of the employer. And the reason now why we're seeing this shift is just naturally because of, well, the whole changing tides in the economy. The Federal Reserve Bank is working now to bring down inflation by raising interest rates. These higher interest rates mean that it's more expensive to borrow money. And if you're a business, your debt costs have risen because businesses don't have 30-year fixed rate mortgages. They have adjustable rate mortgages. And so now when you have a lot of debt on your balance sheet, you have a lot of debt on your books as a business, this debt is going to readjust at a higher interest rate, which means your costs go up, in addition to the inflation making your costs go up. So now as a business, you have higher costs and revenues are not growing because the economy is slowing. And so now you're having to make these decisions. And the reason why businesses are really struggling is because of how fast businesses boomed in the last number of years. See, in 2020, 2021, and even in 2022, there was a ton of free money. And we saw this in stimulus checks and unemployment checks, but it wasn't just for people. Businesses were also getting tons of free handouts from the government. They were getting free loans. They were getting free grants. There's a lot of free money going to businesses. And so now when you're a business and you get all this free money, what are you going to do? You're going to want to expand. You're going to want to grow. You're going to open new industries. You're going to open new operations. You're going to hire more people. You're going to open more stores. You're going to open more manufacturing plants. And this created a huge boom, which also resulted in way more job openings because businesses had the ability to hire. But now that is changing. We haven't seen the full effect of the higher interest rates yet, but we're starting to see this change, where now that free money is going away and businesses are now having to make profit of all the growth that they had. And a lot of businesses are now saying, we don't have the capacity to manage all this growth, all this hiring that we did in the last few years. So now we need to downsize. And that is starting to shift the tides. Now, this is where a lot of people have opinions as to how much the tides will shift. Some people are saying it's just going to be a mild pullback. Some people think it's going to be a lot more severe. Some people say there's going to be no pullback. But this is what's happening right now. The higher interest rates are shifting the tides in the economy. There's no more free money like there was before. The grants are starting to go away. Debt costs are starting to rise. We're going to see more and more debt costs rise over the next 12 to 24 months. But that's where now we're going to see a real shift. And along with that is going to be the shift in the power of the workplace. In the last 3 years, it's been in the hands of the employee. Now we're starting to see that start to shift. It hasn't completely happened yet, but we're going to see more and more of that shift as the economy continues to hurt. If the economy continues to hurt, if we continue to see this slowdown in the economy, there's going to be a bigger shift. And that's going to cause a lot of changes in the workforce. And if people don't want to go back into the office and they're not willing to work, well, you can do that when you have other job opportunities. If you have another place where you can work from home, great. If you have another job opportunity, or if you have savings or you have investments that you can fall back on, great. You have the money and the wealth to do that. You have that power to do that. But when that other opportunity goes away, or when you don't have the money to fall back on, that's when you'll start to really see that shift. So what does this mean now? Well, if you're an employer, you better get serious with your business and your operations and make sure you're running lean, make sure you don't have a bunch of operational costs, and make sure your productivity is still high. Period. You don't have any other option. If you're an employee, understand the shifting tide. This is going to be happening over the next 12 to 36 months. You're going to see a lot of shifts in this. And you can hate it. You can hate me for telling you this. Look, I'm not here to make friends. I'm just here to help you be better with your money. I'm just telling you what's going on. But in the next 12 to 36 months, we're going to see more and more shifts with this happen. So if you are an employee, understand that this shift is happening on the employer side. And if you need the job that you're in right now, the common trend right now is if somebody doesn't want to come back into the office, you're going to be the first one to go. Period. And so understanding that and figuring out what type of lifestyle you want, what type of job you want and what type of career you want, and if the job that you're at right now is going to provide that. So just be honest with what's happening, understand it, and then make a decision based off of that, and understand that, the work from home culture is changing. And if you want the ability to be hybrid, you're going to have to now prove it even more. And you might say, but Jaspreet, I'm already working hard. I'm doing this, I'm doing that, and I don't want to work hard. Look, if you want your company to let you work from home a couple of days a week, you're going to have to prove it, because in the business's perspective, productivity is going to become essential for each employee. And if you cannot show that, they're not going to be able to approve it. This is the situation that we're in right now, and that's why I want you to understand this. That way you can be proactive and take the best care of yourself. That way you have the ability to take care of yourself, your family, and your community, right? Because if your company's struggling, they're going to make certain decisions. And you want to know what factors and criteria they're going to be looking at when they make these decisions prior to that decision being made. That way you can make sure that you are protecting yourself. Now, does this guarantee you're going to protect yourself? No. But these are the factors that companies are looking at. An employees' productivity and ability to come into the office are now crucial. Google talked about this. The CEO of Google said that in the coming productivity meetings with employees, one of the things they're going to look at is how many times the employee signed into the office with their badge. These are going to be things that are discussed in their quarterly or monthly meetings with their superiors. So yes, tides are changing. It's not just tech. It's going to be happening in other industries. So understand this. Know what's going on with your company. Obviously, every company is different. Every person is different. But understand what's going on. That way you don't get blindsided by what's happening, and you can be proactive and take the best care of yourself, your family, and your community. Our work culture in America is changing again. We went from the Great Resignation to quiet quitting to a new trend today called loud quitting. Now, if you're like me and you've never heard of the term loud quitting, let me read you exactly what it means from Good Morning America. Loud quitting is when people aren't just unhappy at work, they're resentful that their needs are not being met, and they're acting out on that unhappiness. Workers in this category tend to undermine what the organization is trying to get done and share their discomfort with others in the organization and even outside the organization. In other words, loud quitting is people who are going around telling their employees that this work sucks, I don't like my job, this is too much hard work, I don't want to be here anymore, and then they're posting on social media that my company sucks. Here's the thing, there are two factors that allow these types of employment trends to happen. Number one is an employee's perception of their work, and number two is the employment climate. Now, if we start with an employee's perception of their work, if an employee feels overworked, undervalued, and underpaid, they're going to want to make a change or do something to potentially undermine their company because they're not happy at their job. But they only have the real ability to do that comfortably when you have number two, which is an employment market which facilitates these types of employment trends. Right now in America, we are seeing the strongest labor market that we have seen in decades. There are more job openings available than people who are looking for a job. If you are unhappy with your job, or if you don't like your work environment, or if you don't like going into the office, or if you don't like something about your office, you can quit. Or you can be fired, and it's not that big of a deal because there's 5 other job openings out there. Now, are they the perfect job openings for you? Maybe, maybe not, but there's still job openings out there because employers are looking for employees and there aren't enough employees out there. Now, from a purely economic standpoint, this is where it's important for you to understand how we got to this situation in the first place, because the reality is that this job and economic market is not going to last like this forever. Let's go back to the chart from the Bureau of Labor Statistics, and what you'll see is that in August 2013, there were almost 3 unemployed people for 1 job opening. Today, there's more than 1 job opening for 1 unemployed person. When did this change happen? After the huge unemployment spike during the 2020 pandemic. That brings us to the natural next question. What happened during the 2020 pandemic, which was the worst recession that we have seen since the Great Depression, to create so many more jobs? And there's really only 2 potential solutions. Number 1 is that there's not enough people anymore to fill the jobs, or there's way more jobs that were created during the pandemic. Let's start by taking a look at the number of employees out there in America. Now, before we get into that, I wanted to briefly remind you that on August 15th, 2023, this year, I'm hosting my first ever virtual summit. It is on the 52nd anniversary of the dollar being taken off of the gold standard. And in this virtual summit, I'm going to be going over how the economy has changed, how money has changed, but even more importantly, how you can seize the new opportunities in this economy. There's going to be so much value in this live virtual summit. It's my first time doing it, but there's going to be a ton of value and a ton of things that I'm going to be going over. So if you want to join, there is a limited number of seats because the software that we have has a limited number of people that they can host on a live call. So if you want to join, make sure you click on the link down in the description below, reserve your seat and be there on time because there's a limit to how many people that can come. It's going to be a lot of fun and a ton of value. So if you want to check it out, I got the link for you down in the description. Now, if we take a look at the amount of labor that we have in America, back in 2020, there were 335 million Americans here. In 2023, that number had grown to 339 million people in America. So if our population is rising, that would generally mean that the amount of labor and workforce that we have in America is also rising. So the reason we have this flipped job market today as opposed to 10 years ago doesn't look like it's because we don't have as many workers today. That leaves us with option 2, which is we have more jobs available today than before the pandemic, which might seem a little bit strange when you consider that this pandemic was supposedly the worst economic downturn since the Great Depression. So how could we have more jobs created now than before? Well, thanks to your good old friends at the Federal Reserve Bank, the government, and the money printer. Between the years 2020 and 2021, the government created the PPP loan for businesses. They created free money through grants for businesses. They created bailout programs for other corporations. All this money creating and stimulus was a massive boost for the economy and bank balances because now you had all these businesses that went from kind of on the verge of bankruptcy to being okay to now all of a sudden, after this money printing, having more bank in their accounts than ever before. So now when you have tens of thousands of businesses with a pocket full of cash, what do? They're going to work on creating new jobs. They're going to work on opening new stores. They're going to work on creating new products. They're going to work on investing in research and development. They're going to work on creating new manufacturing. All of a sudden, we saw this huge, massive boom in the amount of jobs out there because businesses were given so much free money to go out and do whatever they want with it. Some people obviously did stock buybacks, but so many businesses had the ability to go out and create jobs and create new products. But the kind of tricky part with that is when businesses create products, they need people who can actually buy these products. And if you're going through this massive economic slowdown where people don't have jobs, how are people going to create money or have money to go out and buy the products that all these businesses are now creating? Well, the stimulus wasn't just for businesses. The United States government, with the help of the Federal Reserve Bank, passed stimulus bill after stimulus bill after stimulus bill, which created trillions and trillions of dollars of new money, new infrastructure programs, new job programs, new unemployment programs, new stimulus programs that way now people also had the ability to get some free money. In fact, many people during the pandemic were making more money in unemployment than they were working a job. Now think about that for a second. The government doesn't have any source of income. The only income that they get is from taxpayers through tax dollars. But already the government is spending more money than they bring in. That's why the government has this massive amount of national debt. That's why the government has this huge national deficit. That means they spend more money than they bring in. So the government doesn't have money to spend as it is, and then they're spending trillions and trillions of dollars on stimulus. Where does this money come from? The Federal Reserve Bank has to print it. So now the government doesn't have money to spend, but they pass these multi-trillion dollar stimulus programs, which gives free money to everybody. Now, all of a sudden, people who didn't have jobs, who weren't working, were getting these huge chunks of cash, whether it's stimulus checks, whether it's unemployment checks, and businesses have all this money to create new jobs, to create new products. That means all of a sudden, there's products out there, new products, new stores, and I got the money to spend. This was a field day for the economy. That's why we saw the economy boom then in 2020. We saw it boom in 2021. We saw it boom in 2022. And then once interest rates started to rise, it started to slow down. Now here we are in 2023 and everybody's wondering, are we going to continue seeing economic slowdown with the higher interest rates? Are we going to continue seeing economic boom? But this is where now, going back to the job market, you have to remember, no market, whether it's the stock market, real estate market, crypto market, gold market, no market can go straight up forever. No market will stay in one place forever. Today, we are in an employee-favored market. Employees have the upper hand because there are more job openings out there than there are employees. That means employees have more negotiating power. But that doesn't mean it's going to always stay like that, because the Federal Reserve Bank is working to pull money out of the economy. They're working to raise interest rates. They're working to cool down the economy, and they're working to soften the labor market. They say that. What does softening the labor market mean to you? Softening the labor market means it can't be so tight. It's tight because, well, there's so many people, so many businesses that are looking for people. But if there's not so many businesses looking for people, there's not that many job openings out there. Now, there's more people looking for jobs than there are jobs. That would mean then the upper hand would go back to the employer. So, what I want you to remember now is right now, employees have the upper hand. But it won't always be like that. And when it shifts back to the employer, if you live in a utopian world where you think everything should be your way and you're not willing to put in extra work and not willing to do the work, then things will get a lot more difficult, especially in the job market. Because if things were to flip, where the economy slows, people don't have jobs, and now only a few companies are hiring, who do you think the employer is going to want to hire? The person that's going to just keep complaining and not want to do the work, or somebody who's going to be willing to do the work? And that's a decision or a thought you might not have to worry about right now, but it's something you want to understand, because job markets change, assets change. Nothing can go straight up forever, and things don't go straight down forever. And right now, the job market is starting to change. We've been seeing the layoffs. We've been seeing the cooling in consumer spending. We've been seeing the cooling in certain parts of the economy. And if that continues with higher interest rates, you have to understand that as an employee, if you want to maintain your health as an employee, you want to maintain your position as an employee, you have to be able to continue to provide value to the employer. Because what happens when you see economic downturns is employers start to demand more productivity. Why? Because their costs are rising and their revenue is falling. So they're going to be doing layoffs. And when they do layoffs, guess who they want to keep? They want to keep the top performers. So understand that no job market can stay in one place forever, but I want you to understand how the job market is shifting. That way you can make the best decisions for yourself, your family, and your community. Your 20s are a time when you first start making money, and it's very common and normal to be dumb with your money because, well, it's the first time you ever make money. So now you want to go out and buy the nice things, you want to start spending money, you want to start going on vacation, you want to start buying a nice apartment, you want to get a nice car, and you want to just start exploring and enjoying life because you're finally out of school and you're finally making some money.